share this special training with you. I know so many of you have asked for help with short chart training, and we're going to use the 2-hour chart. Now, all of our typical rules as far as understanding the Heikin Ashi candlesticks apply. Occam's razor, which is keeping things as simple as possible because that's typically the best way to do things, applies. I have people ask all the time, why don't you use a volume indicator? Why don't you use stochastics? Why don't you use, on and on and on. We could have 1,000 indicators. The problem is that they all can lead to confusion. You can end up having too many things telling you too many things to do with too many indicators, and it just becomes confusion and you do nothing. Now, short chart training requires lots and lots of practice for many, many months with specific charts. If you're interested in a stock, if you're interested in a certain index, SPY, QQQ, TLT, GLD, whatever they might be, or you really have a stock that you want to follow and learn how to short chart trade it. When you start dealing with stocks, there's a lot more things to consider. That is when the dividends will be announced. That is all sorts of corporate earnings reports and any number of other things that can occur. Leadership changes and all can totally trash you. That's one reason we stay away from stocks and we only look at certain indexes. But whatever you're interested in, you can see if it is chartable. Now, I will be the first to tell you there are many things that are not chartable and you are wasting your time trying to chart them. You can practice and see if they're chartable. You can go back in time and see if the things make sense, but there are a number of rules to pay attention to when you are attempting to learn how to trade on a short chart. If you're going to buy and sell options and those kind of things. Now remember, the caveat is we are not a stock calling service. We're an education firm. We want you to practice. We want you to do virtual trades. We're not giving you advice on how to trade real money. That is not what we do. We don't take responsibility for that at all. We want you to practice with us. Take into consideration everything we say, everything you read, everything else you study. Put it all together and develop your own method. That's the best way to do it, with things that you feel comfortable with and can follow constantly. Remember, certain ETFs, certain stocks are tradable at certain times in the year, certain months, certain weeks, and other times they are not. So pay attention to what works when and how. And literally the time of year can be very, very important. Don't forget that fall-winter trading zone is all important. The summertime is the most difficult time, and we're looking at the charts now during this time of year, the most difficult time to trade. Why? Because there's not a lot of volume in the market compared to the fall-winter trading zone when people come off vacation and a lot of the volume gets back into the market. But nonetheless, let's look at some rules that you can practice and apply. Now, and we're looking at S&P 500, and what we want to look at is remember a number of things. Remember what your longest term trend is, and that is for us the weekly chart. Now we do look at the quarterly chart occasionally, that's only once a quarter. But the weekly chart, where is the weekly chart? Is it in an up move? And as we say over and over, all things being equal, the market tends to move in the direction of the largest chart. That is the weekly. Now things do change. The market would never go in the opposite direction if they didn't. So that can start happening. And sometimes you can find that in the short chart first. But it's also important to look, and we do use the derivative oscillator quite a bit when we're finding short chart trades to practice. Why is that? Well, the derivative oscillator is, of course, an oscillator just like our price percent oscillator is, but it can give you some hints at where the oscillations are occurring first. Now, as we start looking, we want to see peaks in either the green boxes or the red boxes on the derivative oscillator. If you are in the market itself is in a confirmed up move on the weekly chart, like we said, it's going to tend to move up until that wears out and starts to change. And at the same time, you want to watch for changes in the oscillation on the derivative oscillator on your 2-hour chart. You'll see things tend to peak out, like bottom out, because right now the SPY is in a confirmed up move on the weekly chart. And what we're looking for is for the red derivative oscillator to peak out in a bottom move and then to start to turn around. Your Heikin-Ashi candlesticks mean a great deal. When you see things, strong red down candles turn into strong green up candles, not open box, but closed box strong up candles, that can tell you that a move is underway. And when things tend to bottom out, what you see happen is, remember, strong red down candles are strong down movement. And when you go from a strong red down candle to a green solid candle, that is still down movement underway, but it's telling you that it's going from red to green. Doesn't mean you can get in right then, but you want to see that coincide with a bottoming out of the red candle and then a green solid candle, and you want to see the derivative oscillator go from hitting a bottom to starting to move up. And this is right as that up move begins. You want to see that green solid candle many times followed by a green open box candle, which shows you stronger up movement. And what happens is the red derivative oscillator bottoms out and starts to get smaller. When that happens, if you have a green solid green candle, means that your strong down movement is coming to an end, followed by a green open box candle and the derivative oscillator losing downward momentum, starting to move up, and at the same time your price percent oscillator starts to move up. And of course even crossover going up, which is typically a good sign. Here's where you've got to really pay attention, and this requires you to look at the charts a lot more because things can change on a dime. In other words, you're looking to jump in and to ride that short wave up to its peak and then to jump out before it moves back down again. Now there's some really interesting things that can occur, and I want you to see it on the chart that we're looking at. We see things bottom out on 4 p.m. on Monday the 25th of June. And then on Tuesday morning, the 26th of June, we see the derivative oscillator starting to lose downward momentum, moving up. We see a green box form, and then things move up for several 2-hour time periods. It gets a little concerning when you start seeing red open box candles. That still means there's up movement, but it's not a solid down candle. Solid candles, of course, in the red mean strong down movement, which is, of course, an immediate trigger to get out of that trade. So how do you capture the movement during that short time period? Part of it is making sure you understand typically how those up movements are riding, how long are they typically lasting, and how much do you want to try to make in that virtual trade during that time period. And again, we're talking about options. So what you typically do when you purchase an option, what we do is go ahead with your virtual option purchase and try to lock in a certain percentage profit so that it's sold out automatically. That means the minute you buy, you put in a good till canceled sell order, X percent that you would like to make on that trade. And you watch those candles and see if indeed there's going to be enough price bump up on the typical bump ups that you have to be able to capture that bit of profit. Now, as we look at what occurred around the 26th and 27th, we did have a decent jumping in point somewhere around 170, 105, and again, popped all the way up to 173.68. So again, that's about $2 worth of price movement to capture that would be nice to get. But immediately following that, we had things drop down. Now, what's curious about it, when it does start to drop down, and this gives you a hint that stronger up moves are potentially underway when you see a seesawing on the green here, and it'd be the opposite on confirmed down moves if the weekly candle were to confirm down move. That's telling you that the market tends to trend down. Here the market's tending to trend up. And at some point what you really want to capture is the beautiful up movement that really takes off there at 2 p.m. on the 5th of July. And again, this is sort of a tricky, weird time period. If you guys recall, the market was closed on the 4th of July. We're going into a holiday weekend. All sorts of, strange mechanisms can take place then. But you need to practice through all those things to see, again, use your trader's journal, particularly use your trade worksheet. Of course, those of you who listen to us, you know those trade worksheets are available free. Just print them out. You can also buy a trader's journal, but it's set up actually, as you know, for our weekly market worksheets. The trader worksheet will help you a lot in putting down what you're learning as things go along. But as you see, we have that nice up move between the 26th and halfway through the 27th. Then the market drops over going down. We see the derivative oscillator losing momentum, and it sort of bottoms out, goes a little bit red at 2 p.m. on the 28th. And then all of a sudden it starts to pop up again, crosses over on the price percent oscillator and moves up and then bottoms again. But it doesn't go red at that point in time. It actually slides sideways, and we see that telltale solid green candle, actually two of them in a row. And then, but we never have a crossover on the price percent oscillator, and the derivative oscillator never goes negative, which is telling you that it appears things have sort of found a bottom somewhere around about 269.23. And the derivative oscillator loses energy, bottoms out somewhere around where it starts to move up in the afternoon on the 2nd of July, and then things really start to take off for the good. We see that the price percent oscillator continues to move up. Derivative oscillator stays in the green. We have a red open box candle, a red solid down candle, small, followed by a green open box. Again, this is where things are really oscillating in price and getting ready to literally take off. And all of a sudden, we see the derivative oscillator gaining energy, the price percent oscillator heading up, and we go to green open box candles, one after another, after another, after another. And that's where the market really flies up. That is the absolute sweet spot. Things are sort of hopping around in here, and it's a little bit dangerous. You're in, you're out, you're in, you're out, and you're getting yourself set up for a real strong up movement. As you see things, they've already sort of hit a bottom. They move up, they try to bottom again, and then once that move really takes off and the derivative oscillator continues to maintain positive momentum, the price percent oscillator starts heading up, you're on your way to real solid gains. And we see at 2 p.m. on the 5th of July, we see price movement around, let's see, 271, almost 272, and then things take off and fly up all the way to the height of the derivative oscillator right at the 276.56 mark. So again, that's a good $4.50 move or so, and beautiful movement up there. And then once you see things sort of plateau, they can still move higher, but once that derivative oscillator tops out and starts to plateau, you can continue to watch the price percent oscillator heading up, but when it plateaus also and starts going flat and the derivative oscillator is losing energy, and you start seeing red candles pop up, you know you're getting ready for a down move. You take your sweet spot of the dollars that are available there, and then you pull the plug and step away. If you've already set yourself for, say, a 20% profit, which is a nice profit to typically make in an option, you can be in take the 20% and jump out and don't worry about how high it goes, or you can keep monitoring things and ride that all the way up. Things to take away from this are, you've got to pay close attention to your candles. You have to pay close attention to the changing candles and to the red candles, solid red, and of course the solid green, which can portend the bottoming, and pay close attention to your derivative oscillator and how it stays in the green on these up moves or stays in the red. Things will initially try to find bottoms, but once it finds that bottom and your candles convert over to green open box candles going up, and your derivative oscillator starts moving up and your price percent oscillator is moving in the same direction, you ride that gravy train until you start seeing the derivative oscillator losing its momentum. Remember, all things being equal, the market tends to move in the direction of the largest chart. This is not easy to do. It requires lots of practice, lots of trial and error, and lots of willingness to pull the plug. Remember, the number one rule in trading is not to lose money. The number two rule is to make money. And the rule over everything else is practice, practice, practice. Thank you again so much for your support of Charting Wealth. We'll be bringing more of these things to you in the future. In fact, we're going to start working on a book on just short chart trading. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters.